Nuburu Inc. is currently trading at exactly 0.21 USD, down by 0.0077 points or 3.54% regarding intraday movement at this precise moment. When you see a stock handle trading at 21 cents, the immediate instinct is to look away, assuming this is just another microcap equity that has been crushed by the weight of its own ambition. But the price action we are witnessing today tells a far more complex story than simple capitulation. We are seeing a contraction that suggests a lack of bid support at key technical levels, effectively flushing out the weak hands who entered hoping for a quick scalp. Yet the volume turnover suggests that beneath the surface, there is a quiet accumulation occurring by entities who are betting on a binary outcome that the broader market has completely ignored. The general consensus, the expectation, if you will, is that Nuburu is a company on life support, a manufacturing firm that burned through its capital and is now drifting toward the inevitable heat death of a delisting or bankruptcy. Investors look at the chart, see the jagged downward slope, and assume the technology has failed or that the market simply does not want what they are selling. However, the reality is starkly different and far more terrifyingly high stakes. We are not looking at a failed product. We are looking at a company possessing a proprietary physics-based advantage in blue laser technology that is absolutely critical for the next generation of electrification and defense, yet it is trapped inside a broken balance sheet. The tension here is not about whether the laser works. We know it works, but whether the corporate entity can survive long enough to sell it, or if the intellectual property will eventually be stripped away and sold to a giant like huge industrial conglomerates for pennies on the dollar. This is not a slow decline. This is a high-speed poker game where the chips are intellectual property patents and the blind is the company's remaining cash reserves. When you analyze the intraday movement of being down over 3%, you have to understand the psychological warfare happening on the order book. Retail traders on the Robinhood app or those engaging in Robinhood stock trading are often looking for the next massive squeeze, reacting viscerally to every tick downward, often panic selling when the stock breaks below psychological support levels like 25 or 22 cents. These platforms gamify the experience, making a 3% drop feel like a catastrophe, which accelerates the sell-side pressure. In contrast, if you were to look at the behavior of algorithms managed by Schwab Intelligent Portfolios, or the more passive strategies found in Fidelity Wealth Management accounts, you would see a complete absence of participation. This stock is too small, too volatile, and too dangerous for the standard Fidelity mutual funds or SoFi robo-advisor algorithms to touch. This creates a vacuum of liquidity where only the most aggressive high-frequency traders and speculative retail accounts are battling it out. The drop to 21 cents today is likely exacerbated by the recent Q3 financial results, which we will discuss shortly, but it also reflects a broader sector rotation where capital is fleeing high-risk industrial microcaps to chase yield in safer assets. However, this lack of institutional safety net is exactly what creates the asymmetry. If Interactive Brokers traders are shorting the stock, they are paying massive borrowing fees because the float is tight and the risk of a sudden news-driven spike is immense. The market is pricing in death, but if the company announces a single major contract confirmation with a defense partner, the re-rating would be instantaneous and violent, catching every short seller off guard. Let's pause and address the actual business, because this is where the disconnect between price and value is widest. When you think of Tesla stock, you think of electric vehicles, batteries, and sleek manufacturing. When you think of NVIDIA stock, you think of high-performance computing chips that get incredibly hot. Both of these sectors, EVs and high-performance computing, have a massive shared problem: copper. Copper is the backbone of electrification, but it is notoriously difficult to weld with traditional infrared lasers. Infrared lasers, which are the industry standard used by most legacy manufacturers, tend to reflect off copper rather than absorb into it. This leads to defects, spatter, and weak welds. Nuburu's entire existence is predicated on the physics of blue light. Blue light is absorbed by copper more than 10 times more efficiently than infrared light. This means Nuburu's lasers can weld copper faster, cleaner, and with zero defects. This is not a marginal improvement. It is a physics-based step change in manufacturing capability. So why is the stock at 21 cents? Because developing this hardware is incredibly capital-intensive. The company has had to build the market from scratch, educating potential clients who are used to doing things the old way. It is the classic innovator's dilemma, having the superior solution but running out of runway before the market fully adopts it. While you might be comfortable holding Apple stock because of its massive cash pile, holding Nuburu is like holding a call option on the physics of manufacturing itself. The recent trading sessions have been brutal, and today's slide continues that trend. We are seeing a volume profile that suggests exhaustion. The sellers are tired, but the buyers are hesitant. This standoff is usually resolved by news. Just recently, in November 2025, we have seen a flurry of headlines regarding their pivot toward defense. This is the critical reality check that most passive observers miss. Nuburu is no longer just trying to sell welding tools to car factories. They have aggressively pivoted toward the defense and security sector. The partnership with Techne and the acquisition of Orbit are attempts to reintegrate their blue laser tech into military applications. Think drone defense, optical communications, and directed energy. This is a sector where margins are higher and contracts are stickier. If they can successfully transition from a pure industrial play to a defense tech contractor, the valuation multiples expand dramatically. This pivot is the only reason the lights are still on. It is an attempt to secure non-dilutive government funding or defense contracts that are recession-proof. Yet the market is skeptical, which is why we are trading at 21 cents. The skepticism is warranted, but it also means the potential upside of a successful pivot is not priced in. If you are sitting there with a Fidelity trading platform open, looking at this chart, you are seeing a company that looks broken. But if you look at the press releases, you see a management team that is frantically re-engineering the business model to tap into the massive global defense budget. We must address the elephant in the room, the financials. The Q3 2025 report was difficult to read, a net loss widening to $22 million with virtually zero revenue recognized in the quarter is a terrifying statistic. It shows a burn rate that is unsustainable without constant capital infusion. This is why we see continuous pressure on the stock. The market anticipates dilution. Every time the stock pops, investors fear an offering is coming to plug the cash flow hole. This is the mechanic that keeps the price suppressed. Companies in this position often have to turn to toxic financing or heavy dilution to keep the payroll funded. If you manage your own money using SoFi Invest or Robinhood Investments, you need to understand that your equity is being diluted to keep the lights on. This is the cost of entry for a pre-revenue deep tech firm. The substantial doubt regarding the going concern status issued in the filings is a standard legal warning for companies in this position, but it serves as a stark reminder of the risk. However, the recent elimination of some long-term indebtedness and the restructuring of their balance sheet earlier this year shows that they are trying to clean up the mess. They are trying to make themselves attractive for a buyout, and that is a very real scenario here. A major industrial player or a defense prime could acquire Nuburu for its patent portfolio alone, likely at a premium to the current 21-cent share price, but perhaps lower than the average cost basis of long-term holders. Comment below how many shares of Nuburu you currently hold and what your average buy-in price is. Are you holding for the defense pivot, or are you trapped from higher levels? Let's go deeper into the technology, because this is what protects the company from going to zero. The Blue Laser intellectual property portfolio is robust. In a world where Tesla stock dominates the conversation about batteries, the actual manufacturing of those batteries is the bottleneck. Nuburu's AO150 and BL series lasers allow for what is called conduction mode welding on copper, which creates a smooth, defect-free surface. This is vital for the electrical conductivity required in next-gen batteries. If you use an infrared laser, you often have to use keyhole welding, which is violent and creates voids. Voids in a battery weld mean resistance, heat, and failure. Nuburu solves this. The problem is that the automotive industry moves slowly. They validate equipment for years before buying.